Hey everybody, welcome back. CPI is out and it was pretty much a dumpster fire across the board. Most importantly was just the reaction. So let's just dive into the short term and then we'll get into the long term of it in a moment here. But if we look at the level, we always mark off that first 1 minute bar. And this is something that we've gone over ad nauseum, but for those that are newer, what you like to do is that first minute whenever news hits is you just mark the high and the low of the ES and all the exchanges. And what you'll get is you'll get a real clear understanding of what's going on. This will tell you where the algorithms are in the high frequency traders. And you can see very clearly that they have their levels marked. And so basically what we're doing here is we're just using the algos and high frequency traders against themselves, right? Once you understand what they're doing, then you just start using it to your advantage. But what's important about that level is this gave you an excellent spot to do a couple things. So it gave you a really good spot to actually put on a short if you wanted to. If you're like, oh, geez, I missed this. Well, by 10:30, there it was. It doesn't get any more obvious. And then, of course, you can just go right through this. And just FYI, if you ever click this stay in drawing mode button, I just found this out. It'll just continually just keep giving you exactly what you want. I didn't know that before. Someone was nice enough to point it out and save me a lot of time. But what you're seeing is when you mark these levels off, it just makes your life much more easy. And then you can just kind of come across, and what you see is you see the same thing over and over and over again. Now, the Qs actually held up better than anything else. And if we take a look here at the RTY, you're going to get the same exact pattern at the same exact time. Let's click this off for a minute. And you can just see it. I mean, it was absolutely perfect if you were looking to short something. But from my perspective, the fact that you couldn't clear that level told you everything that you needed about the indexes today. And we can actually pull this down all the way and see it from here as well. So this gives us a clear indication of what's going on out there. Now, there were two big events today that we should talk about. So the first one obviously is going to be CPI. But if we take a look at the 2-year and we drop the 2-year down to a line chart, let's throw this over. We're approaching that 5% again, right? And we can see that we were there. And let's get back to this. Let's kick this out on a day chart. And let me show you where we're going with this. So where were we in 24? Okay, you were at like a 430. Okay, now where are you? You're almost at 5 again. And you're approaching this. So this is getting pretty serious in my opinion. I need to click on the candle because it takes a while for the other part to click in. But if you take a look at this, it's pretty impressive, right? Just a pretty staggering move to say the least. So the question is, are we heading back to here? There's some reason to believe that that could be the case. Now you had the 10-year auction today. And the auction went poorly. I was asked to explain what it means when it goes poorly. Poorly means that they had to increase the yield in order to get people to buy the debt. Now, this has a lot of ramifications, not only for the market, but also for the U.S. economy and the ability to issue debt. As we have staggering debt right now, the higher rates go, the harder it is for us to pay that debt, right? Because you're just Think of it even as a credit card from a credit card standpoint. And right now you're at a historical high, which is around 18 or 19% of GDP is going directly to interest payments, which I don't think we've seen since 94 when we were in a full-blown recession. So are we heading back to this level? Yeah, it's a really good question, and I don't have an answer for you. But I can tell you this. If you take a look at the 2-year, and right now you're at a 454, and where we were in the beginning of January, which was that 380 level, and you come here and take a look at this, and then go take a look at the 2-year watch. Okay, and all of a sudden, you're down here again at 4, right around this level. Well, these spreads are starting to get widened. So in other words, if we go here and take a look at the 2-year, 10-year spread, once again, it's getting wider and wider. Well, that's not ideal at all. And this is certainly something that we have to pay attention to. My larger problem with this is that there doesn't seem to be an end in sight to it. So the question really becomes, how are they going to get inflation under control? Because it's very clear that it's not under control. We've had some really good moves today. There were some great trades that were able to be had, but they were technical bounces. And I'm going to address a couple of them. But I think it's important to understand that you're always going to have great ideas to trade. But the larger question is, how are they going to get this under control? Because it's no longer where it's been dropping, right? We're not seeing that, quote, drop anymore. We're seeing the exact opposite. We're starting to see more of a raise now. I'm going to draw that line here. But that drop from here down, that was driving us. And that was really predicated on a couple things. That was predicated upon the global manufacturing PMI dropping across the globe. And it's been increasing since January. We're going to talk a little bit about that. But I think it's a really important question that you have to ask yourself and saying, if the issue is gasoline, if the issue is shelter, right? And as of now in the US, you have more people here than I think we've ever had. Shelters, they're not building a lot of new homes right now, right? And that's why you're seeing like Toll Brothers and all these names. I mean, they're at record highs, even though they're grossly overdone, in my opinion, as far as height. They're way overbought, in my opinion. But sure, you're a little weaker today because they're not cutting rates. But you still have this huge demand for housing. That's not going away. So shelter prices, I don't know how they're going to drop. I don't know when that drop is going to kick in. We went over this yesterday. And I'm not really sure what out there is going to get the gasoline prices down, which was also the issue. And we can see here that, yes, of course, we're not going up as high as we did the previous in February. And we went through this yesterday where you had an 11% gain month over month. But if you come here and look at it, you're still up 5%, 4.5% month over month. That's still a staggering amount to be up. And I definitely think that's certainly something that we have to pay attention to. But let's get into it. Now, CPI came out and it was obviously higher than expected. And let's just look at the headline. So shelter and gasoline were the issues. Gasoline was pretty easy to predict. I showed you yesterday how you could predict that gasoline was going to be higher than anticipated. It's really a very back envelope way to do it. I'll link the video at the end, but it does tend to work. Half the CPI gains are gasoline and shelter. This is not going to go away. So if you understand what the reasoning is, that's why I clipped this specific article out. We know that gasoline prices are not going to drop for several reasons, right? We don't have a lot of inventory. You have 2 wars going on. Russia just cut supply. So there's a lot of issues here. And shelter, it's the same story over and over and over again. And there's no sign of this getting better. There's a lot of reasons for that. And we actually went over this yesterday as well and how this was pretty predictable, that these numbers, there was just really no way that this was not going to come in a little hot. But some areas came in hotter. We'll get to that at the end. But I think we need to talk about this. So core tops the forecast again, delaying Fed rate cuts. And we're going to show you those cuts and how far out you are now. But shelter, gasoline drive higher. Car insurance jumps while some food prices decline. Trying to put lipstick on a pig right here. Treasury yields soar. That's pretty much an understatement. Stocks drop. Now, we're going to discuss that in a little bit greater detail here. But this one blurb pretty much says it all. Yet another hot inflation report. So that's not 1, that's not 2, but now we're up to 3. So we can't blame it on January and say it's residuals from January into February. And so the Fed cut starting in interest rates in June. We're going to discuss the probability of that in a moment. Morgan Stanley said that depending on Thursday's PPI, now remember, PPI is coming out tomorrow. PPI last time came in higher than expected and also higher on a percentage basis over CPI. Doesn't mean that it's going to do the same thing this time, but it's worth noting. And we're going to talk about how we can start using leading indicators to predict when this might turn around. But for now, I think it's important. The CPI tilts the Fed towards a later start. Paul Ashworth, Capital Economics, was blunter. It kills the rate cut hopes. I tend to agree with this. I think the chances of a cut in June, and quite frankly, I think the chances of a cut right now are going to be pretty darn hard. And there's a lot of reasons for that. So what I want to do is I want to give you something that you can use. I went over this yesterday, and we went over it a little bit on Saturday. But in front of you is global manufacturing PMI. And the reason I'm showing you global manufacturing PMI in this data is from the S&P Global. And you can get this for free right off of tradingeconomics.com. I have no affiliation with them. You can get it wherever you want for free. But this is giving you a great forecast on CPI and PPI. See, the rest of the world right now is actually seeing productivity increase. And we're starting to see manufacturing PMI increase based upon the fact that the rest of the world is increasing and we're trading with the rest of the world. That just makes sense if you think about it that way, right? If manufacturing is going up everywhere and we have a widget that people need, they're going to buy our widgets, we're going to buy their widgets, and manufacturing is just going to increase in volume, which is going to lead to more jobs, more money, which means that if you're in an inflated environment, you're probably going to stay inflated unless you do things to quell that inflation. And how do you do that? By slowing the economy down. How do you do that? By raising rates. We'll get to that. So what you will note is that global manufacturing PMI, and we went through how November and December, for example, and how all these followed perfectly CPI. This comes out before CPI. So another thing that you could use, besides how I showed in yesterday's video how to use crude oil and how to use gas to do this, you can look at global manufacturing PMI and you can look at US manufacturing PMI to get a better understanding of where we're going to be on the CPI data. And that makes a lot of sense if you think about it, because if you're increasing manufacturing PMI, remember, Purchasing Managers Index has 2 parts, right? The first part is manufacturing, the second part is services. If both of those are over 50, which means expansion, right? then how in the world is CPI going to go down? It just isn't, right? It's not feasible. So this is one way to look at the world and one tool that you can now put in your tool belt. And then again, all I did here was, this is all trading economics, but I just wanted to show this because I thought it was interesting. So you have that 50 level right there, and you can see how we're over. And if you just draw a line straight across, I mean, this is a pretty significant level you're at. This is a level that you're looking to break, that you were at before, even before we had the pandemic. And you can just see over here how we broke here, and now we're heading back over it. And this was a high. It's not common for global manufacturing to be up this high. So this is certainly something that we need to talk about. And we talked about this yesterday. The last time that we had increased productivity and that there were rate cuts was 1995. I would love to say it, but there's a lot of work to be done here. And it starts tomorrow with PPI. And we'll be live again for PPI, just like we were for CPI today. And yes, I will make sure I am on time. Now, what we have in front of us is the CPI that came in at 0.4, and all the numbers came in hot. We're going to review them. But again, November, December, January, February, March. Now, they're all coming in exactly as global PMI is, global manufacturing PMI. So we're going to want to watch that. It's correlated. It's not cause, but it's correlated. And I think that's an important differentiation. And I certainly think it's something that we have to pay attention to. Now, this is pretty interesting because this is a breakdown. Now, you can get this breakdown yourself by very simply typing in CPI and then today's date, and then go type in the word segment, and you can get it off of Google, or just go to the BLS website, bls.gov. But I just wanted to point out some things here. So what you saw in February was food at home dropped. Now, food at home is starting to get more expensive again. So that's one thing that started to peak up. And what you're looking for is you're trying to find the areas that are going up. So food away from home is going up, right? Well, that's certainly not good for PPI, right? That's telling you that when they're buying goods, they're passing that on to who? The consumer, right? And then you start going through some of the commodities and the energies. And they were looking for gasoline to drop even more. I'm not really sure how they were getting that, but just by looking at gasoline futures, it really made no sense. Fuel oil was down, and then you just see energy services as a whole. And then, of course, electricity just absolutely spiked. And they're not really talking about this. I'm not sure why. But that's a big difference from where we were in February to where we are in March. So that is a very large increase. And then gas is down a little bit, and we're in line here with commodities less food. But if we get to the big dogs, like new vehicles, and we were expecting, and we need to talk about this. We went through it yesterday, and we went through it on Monday, but new vehicles were down. Well, they were looking for a decrease here in used cars and trucks. They were looking for a decrease of 0.8%. And we went through this with Manheim's data and just showed that I don't know how they're getting there just based upon the data of lower inventories, the way the cars were selling. And they gave a really good breakdown on this. So I'm not really sure. You know, we talked about where JP Morgan was and where Goldman were. And this number came in higher. It's not a decrease. So this is not going away. And this is surprising, was something that they weren't talking about in the Bloomberg article. They were blaming it more on, shelter. But shelter really, while they were expecting a decrease, and you didn't get that decrease. If you look at shelter as a whole, and I think that this is really important, just looking at shelter as a whole, what are you saying here? It's pretty much stagnant. What has shelter really done since September? You had a 0.6, a 0.3, and then the most of them have been 0.4. So it's not really going down at all. Transportation services, just based upon gasoline, that's going up as well. And then, of course, people aren't talking about the medical care services, and they're up. So you're up across the board. It wasn't just one thing. It's a lot of things. And where we were looking for declines that we didn't get, what we actually got were increases, and no place is that even closer than something like the used cars and trucks. Now, I actually think this fares pretty good for the CBNAs of the world, and also fares pretty well for the AutoNations of the world. So that is something that we will take a look at. But let's look at how this affected the probability of a rate cut. Now, in front of us is CME Group, when you should be able to see that right up here, and it's called FedWatch Tool. Anybody can go to the site. It's a free site, and you can see right up here where we're at. And again, I heard that these videos are back in HD, so if there's any problem and they're never in HD again, just let me know, and I'll take care of that. I know how to fix it now. So it's the dimensions, and I was having issues with the dimensions because I'm on curved screens. Anyway, so here's May 1st. And for those that don't know, here's the current target rate, where we're at. Here's the chances of rates staying where they're supposed to as of now, right? They're supposed to stay here. And there's a 0.3% chance of a cut. I would basically say there's 0% chance of a cut if you could even get there. A day ago, there was 2.3. Now there's 0.3. But what's important is how far did they kick the can down the line? And I think that this is where it gets somewhat interesting. So if you go out here, there's no chance relatively of 2. And now there's only a 20% chance. By tomorrow, if PPI is hot, which I think it's going to be, it's just my opinion, I just don't see how it's not going to be. But if you take a look at where we're at right here, you're at 80% chance of rates staying where they are in June. Well, that is very different than where we were. And you need to take that into account. So here's a 42% chance as of yesterday that we were going to stay where we are. Now there's an 80% chance we're going to stay where we are. There was a 56% chance of a rate cut. It's now a 19% chance. So the idea that we're not going to stay where we are is an issue. Now, this gets, as we go further down this, to me, this gets a little interesting. But there's a 57% chance now that they just stay exactly where they are in July. And there's only a 37% chance of cutting in July. And that's a big difference, guys. I mean, if you look down here, it's a really big difference. You had a 25% chance of being here. Now you have a 57% chance. Essentially, they're telling you there's no cut in July either, right? And I just think that that's pertinent. So even if you go all the way down here, there's only a 40% chance of a rate cut that got dropped down to 2 rate cuts. That got dropped down. And I think, and then you're here, then you're at 33%. I mean, this just gets worse and worse and worse as time goes on. And, you know, the chances of these being like multiple rate cuts, it's just gone away. We're just not really seeing that right now. And as far as target rates. So this does become a problem for us. And it's certainly something that we're going to have to pay attention to going forward. You go out to September, and you can just see the probabilities up here as well. I like looking at them here because you can see the differentiation. But let's just go to June, because that's really where they smashed our hopes and dreams. Because you were at only a 40% chance of staying here. Now you're having an 80% chance of staying here. I think it's safe to say until you see a turn, the chances of a rate cut, they pretty much went out the window today. I mean, we can talk about the probabilities and the technicals, but you're going to need a reason to cut rates, not just because of the election cycle. I mean, I get that part of it, but there needs to be a reason to actually cut them, not just because you want to. And quite frankly, I think that the administration's making Powell's job a little bit more difficult. Now, I've been asked to give an update, and at the same time, I want to go through a couple things here. So let's go through, how's it going in April? How's life? So again, this is one account, and it's only one account. I'm going to be really clear about that. So in this account, here's the P&L. This is the trade expectancy, and this is for April. And this is the win ratio, and this is the average win-loss. And you'll note that this is off from where we normally are, and normally where the profit factor is. And I guess we can pull that up. So this is a day trading account that I tie into the Alpha Chasers community. I'll also pull this up for a second so you can see what I'm talking about here. So let's go to January, and then we'll go here. So if I'm going to look at this data, what you'll see is the profit factor is 1.86, 1.68, and then the profit factor is 1.86. And then that's what you're up on the year. And the win rate's a little higher because I've been doing less trades, quite frankly. For obvious reasons, because of the market. I mean, that's not rocket science. When things aren't going your way, do less. I mean, there you go, free lesson. And then when things are going well, do more. But what I want to do is I want to show this trade. And it's really important for you to watch this trade live and then watch how we got out of this trade. But let me just jump into this here and show you this trade. So what we're doing is we're buying the break. Let me pull this down. So you're buying the breakout, right? So you reverse right here, and then you're buying that breakout right into it, right? So we bought, I bought 1,000 shares here, and then as it trades up into the previous close, I'm scaling out. And I basically was just doing 3, 2, 1 because I wanted to hold it. So I bought 1,000 shares, sell 300, trades up. We're blowing out 300, 200. And then what I did here, I'll show you if I can find it. So right into Fed minutes at 2 o'clock, they start getting giddy, right? They try to convince you everything's going to be good. And they start bidding it up. And then when they bid it up, I just sold like 100 shares because I wanted to hold a portion overnight. So that's what I did. I mean, it was just 1,000 shares, and I really just did 3, 2, 1. So my scaling out was actually less, not the same amount, right? So I pyramided my scaling, okay? It's a strategy I'll use sometimes if I'm trying to stay in a trade. But I want to lock something in because you're not in the best market here. And we all know that. And this was a pretty easy trade to spot, and we talked about it, but I wanted to review the trade and review where we're at. There's a lot of misnomers about, win ratios and where you have to be. I've talked about this ad nauseum, where real traders are actually sitting. And just to reiterate, if you're at 56% on a win rate, you're killing it. The only thing you're trying to do is optimize that trade. That's all you're trying to do. But let's get to the NVIDIA trade and let's get into it. So a couple things. I walked through this in yesterday's video for everybody, and I showed you exactly what I was looking at yesterday. And you'll note that I do that a lot, right? And what I'm trying to do is trying to get you to understand not only knowledge, but then applied knowledge and then how you do it. So that's why I showed the trade, and then I'm going to show the trade live, and then I'm going to show you the setup so that you can do this yourself, right? Or at least you know how to do it and go from there. So I showed this yesterday, and what I'm showing, I know the date's wrong, but it is what it is. It's 410, I know. I'll fix it. It's on my list of 1,000 things to do. But you see right here how you got to this level. So this is your Bollinger Band. And then based upon that, the first standard deviation is 67%. The second is 95%. The third is 99.7. They're the expected range. You're supposed to stay in that range. The probability of you popping out of this range is 0.3%. That's when they say 99.7, right? There's a 0.3% chance you're going to pump out of that, right? Okay, so that's why when you get to a third standard deviation, you have my attention, all right? So it's definitely something to pay attention to. Is that a reason to buy? No, it's not a reason to buy. Not at all. It's an energy drink for those that are curious what it is, because I'll get comments. And so anyway, so you can see right here, you see how you're popping over? Okay, great. But why would you do that trade this day? Well, you really can't, right? Because why? Because you're going into what? You're going into CPI. So, I mean, it's kind of crazy because you could pop out and pop back in. It's not like it's a wall. It's not just going to stop. So you have to understand that, right? So then you go here, let's go to the bear chart, and let's drop this down. And so what you're doing here is this. You're putting yourself in a position where you're watching right in here, right? And so you break down and then you flip, and that's it. It's risk on. You're either going to do it or you're not going to do it. It's really that simple. And really what you're shooting for to start with is just a gap fill. And then when it gets in here, you're watching it push, and it just presented opportunity after opportunity. But when you see these wicks here, and you see how you couldn't break, I told you everything you needed. It did not tell you the magnitude of the move, but it certainly told you that they were trying to take it back down, especially when they do this. I want you to get this. So this is like super technical stuff, but just pay attention to this for when you say it. See how you have a wick right here? See how this wick undercuts that wick? Why do you think they're doing that? See how this wick undercuts that wick? Why do you think they're doing that? There's only one reason to do that. It's to stop you out and take your stock from you. I mean, there's really no reason. That all they're doing is just jamming it down, right? And then there's nothing there. So again, what are we doing? We're using the algorithms against themselves. That's when people always say to me, oh, the algorithms, high frequency traders, they took all the edge out. No, they created different edge. It's up to you to go and find it. But when you start to see that kind of stuff, it gets pretty clear, right? And then you can see the pop. Again, it's not telling you the magnitude, but it's telling you have something going here. Here, let's just watch it live.
That's a very simple trade, guys. I'm there. See what happens. I'm going to use 837 as a stop. I'd like to stay in it today. If it breaks 837, I'm out. 841's the cost. And if I get stopped out, I get stopped out. I'm not going to do options because I think they're going to bleed us out today. The only thing I have so far are wicks to the downside, which I do like, but I haven't added to this yet. I'm getting wicks here, so that's a good sign. Up 7. Do what you want with it. I'm going to hold it. Zero wrong with scaling out of that everyday trade. You have a $5 bar on a 1-minute chart. You're up $5-6 on this trade, $7. So do what you want with it. Up $11, $12, do what you want with it. Now you probably want to use 850 as some kind of stop on your trade, but I could get another push here. It's not going to be a straight line, guys. I'm going to tell you that now. You caught the early move, but doesn't mean you're not going to come back and backfill and all that stuff. So if you want to take it, there it is. I would not chase it if you missed it and you didn't buy it when we bought it. Just let it do its thing now while everybody tries to figure out what's going on. And the reason it's moving so violently is because you're at that third standard deviation level. We're up $15 now, $17. So you're going to want to watch this right here. See how that goes. Probably going to go right through it. And I'm going to sell some. Sold into some. It's a big move. 5-minute move. I mean, you're up $18 in 5 minutes. I'm probably going to pull something out, guys. You're working it off here. You're working that off. So you're probably going to push through. So now if you didn't do the trade, because you wanted to wait, what you want to do is if you push, you want to see if you're going to get over that. That would be your stop, but you'd have to push over. We were near a third standard deviation, and that's the kind of bounces that you can get. The reason we were able to pull off that NVIDIA trade the way that we were is because we were set. We had the whole thing mapped out, and this is setting up the push. See, like that's telling you already. It's already telling you what's going to happen here, right? You say it, boom, boom. I mean, that's pretty clear. It's a pretty clear breakout. Boom. And then if you did that trade, you want to scale out of some into that move, just in case it doesn't go. You're going to scale out into it. It's the kind of market you're in, so you don't really have a choice. And if you can't move that fast, don't do these trades. Oh, you're going to go higher. You had a huge seller at 85 and just ran them over. What are we up? Over 20 points on the original buy now? What are we up? 30 points? Should close some of that. I don't know how you're just going to flip on the first time. That's the previous day high. You got to flip? What are you going to do? I got to sell into this. I got to sell into strength. I got a lot of this. Just push. Give me 30 points today. There we go. Who's a winner? Third standard deviations on days like today. It's like touching the third rail. This is a place where it would rest. Might break 870. I'm going to kick some. You got to sell her at 870. Sold some. You got to sell her at 870, guys. Whenever you're swing trading or anything, you always mark the previous day highs. And so what I did there was I used level 2. And when I saw the seller came in, that's when I reduced. And now you have a shooting star into resistance of the previous day high. No one's going to ring a bell that this might be a short-term top on the day. Just FYI. I will hold a portion of this, just FYI, to see we're on the same page. I'll hold a portion all the way back to here from where we put the original trade on.
Tomorrow is a very, very important day for PPI, and I'll explain why. So if you're newer, you're not familiar with this, but I'd like to show a stool so people can understand where we're at. So this is really the market as a whole sitting on the stool. Sometimes you're leaning on this leg, or this leg. And there's really 3 legs to me, right? Macro, fundamental, and technical. Right now, we could stare at the technicals all we want. And there's a way to trade the technicals, and we just went through that. That's for short-term trading. If you're looking at this market and you're not looking at what's going on under the hood in the economy right now on the macro side, you're going to have an issue. It's really important that we focus on this. Okay. More so than the fundamentals that are going to start on Friday with the banks that are going to come out, because all the fundamentals are going to shift based upon the macro. That's the way that we're set up right now. So whether or not you want to care about PPI, if you're a swing trader or not, do it at your own detriment. If you're just looking at charts right now and you're not understanding how significant these moves are, you're going to have a real problem trading. And you're going to wonder why you keep clicking on your stops. You need to have at least a modicum of understanding of this. Now, one of the core things that I noticed, and I do want to point out another differentiation that actually bodes well for us, and I'll point that out at the end, because I think it's important to show you something that keeps popping up over and over again. But PPI month over month, consensus is 0.3. Previous was 0.6. Consensus is 0.3. Previous is 0.6. Okay. Consensus is 0.2, 0.3. So when we go through these initial claims, no one's going to care until you get over that 300. Continuing claims, no one's going to care. Year over year, 2.3, 2. Okay. So CPI went up, but somehow mysteriously, this is going to go down. And I just don't see how that's feasible. And I think we saw a lot of that. 2.2 to 1.6. I think we saw a lot of that at the end of today. And it's certainly something that we have to pay attention to tomorrow. So we'll make sure that we're live around 8:15 before this goes off so that we can go over it the same way we went over CPI today. Now, watch this correlation tomorrow. This was pretty interesting to me. This is the Qs divided by the SPY, and it shows the relative performance. So you can see how the Qs have been holding, and they've been holding ever since when? November. Right? Since November, since we popped over, the Qs have been outperforming. And we can see that test of test, right? And we've been down here holding since mid-March. So in other words, we had a period of time where the S&P was outperforming, which nobody wants. You don't want the S&P to outperform. This, right? So let me just show you what it looks like when the S&P outperforms. This is what we dealt with back here, and then we broke down, right? That's the S&P outperforming the NASDAQ. So we don't want that, right? I think we can all agree with that, and we could start to seeing it set up that way. What we want is we want the NASDAQ to outperform. That's a healthier market for us. And we did see signs of that today. For example, S&P was down 1%, ES was down 1%, NQ was down 89 basis points. So we're seeing signs of that. Now, what you're going to want to watch tomorrow after PPI is to make sure that this is continuing. Because if this is continuing and we're starting to base, and then we can pick up, get through the financial earnings on Friday and get into next week where we have Taiwan Semi coming out. And then we also have, let's pull this up on a daily. We have Taiwan Semi coming out on the 18th next week. And then on top of that, we also have ASML coming out, which absolutely crushed last time. They're on Wednesday. If we can get into that and we start having good earnings, we can start looking at some of the other legs of that stool that might be able to support this market. That's it.